Hello, everyone. Hope all is well. Apologize for the delay. I had a bit of a hiatus. Hadn't done any videos for a while. Had a lot going on in my personal life, but was able to overcome those obstacles. Everything is great, and I wanted to go ahead and get back into it. Been getting a lot of questions, and today is going to be a really important video, possibly the most important video I've ever done. And I'm going to essentially give you the game and show you how to analyze a stock chart. And when you start investing in the market, eventually you learn and you figure things out, and you'll start to come up with your own strategies, your own techniques, your own things that kind of work for you. So this is what I do. There's lots of different ways to skin a fish. So over time, you'll figure out your own tweaks and everything. But it took me many years of trial and error, falling on my face, getting frustrated, making money, losing money before I figured this out. This took me years to learn right here. So I'm sharing it with you now, hoping that it saves you some heartache and some pain. And I'm honestly blessed that I was able to get this. So when I started investing, first thing, I learned a very risky and difficult strategy to start out with, and that's trading options. Options trading can be very profitable, but if you don't know what you're doing and you don't understand the rules, you can lose your money very quickly. It's something that I recommend for more advanced traders. Definitely not something you should do if you're just starting out and just learning about stocks. Unfortunately for me, that's where I started. So I started out doing something that I would consider to be the most difficult, and then eventually figured out my sweet spot. So what I'm going to talk about today are called moving averages. There are a lot of ways you can analyze a chart, and people use something that are called indicators. And there's a lot of different kinds of indicators that people use to kind of get a feel of the market. These are the most important indicators, in my opinion, are focusing on the moving averages. Moving averages are critical. And the moving average is essentially the average of the stock's price movement over a specific period of time. That's all it is. And so these lines that I'm going to explain, these lines are moving averages for the stock. I'm on TradingView. TradingView is my favorite place to do charts. And right now I'm looking at Apple. You can see right up here. Any brokerage you join, whether it's Charles Schwab, TD Ameritrade, E-Trade, they have charts you can use right there on their platform. So you don't necessarily have to go anywhere else. But I just like TradingView. TradingView is just the best I've ever found. It gives you so much information, live updates. You can look at stocks. You can look at forex. You can look at cryptocurrency. You can look at anything on it right here in one place. I think that's amazing. Lots of different things you can and features you have here as well. Pause. I forget what I was about to say. All right, so with a moving average, it's an average of the stock's price movement over a specific period of time, and it allows you to make investment decisions based on averages. Not the averages are more accurate than assumptions or short-term news, all that kind of stuff. You're just making it purely based on the law of averages, what it's been doing over certain periods of time, and you can tailor this for a short-term investment trading strategy and long-term. If you're just starting out, you're probably just going to do long-term. Long-term meaning you're buying stocks and you're typically holding them for at least 6 months, a year, 2 years, several years. Long-term growth. You get into short-term when you start getting a little bit more advanced and you take a pot of your money, maybe it's you can come up with a percentage, 10%, 20%, and you can allocate that towards the short term. Sometimes short term, you can make a lot of extra money, and then you can take those profits and then put half of those back into the long term pot and then keep going again with short term. So you'll figure out what you prefer. Moving averages can help you identify trend directions, okay? If it's trending upwards or if it's trending downwards, okay? So I'm gonna show you a couple other things here first. When a stock price crosses over a moving average, so I'll give you an example before I explain that. This particular chart is it's probably the most popular moving average combination you'll find. A lot of your best traders use this. People who are making millions of dollars, they do this right here. Very standard. So this white line represents the 200-day moving average. This is Apple. So over the course of the last 200 days, this is the general average direction that the stock is making, okay? 200-day moving average, that's the white line. The gold line is a 100-day moving average. And I can come over here and see if I wanted to remove it for a second to focus. So the white line is 200-day moving average. Gold line is 100-day moving average. The green line is the 50-day moving average, okay? That blue line is the actual stock's price at this moment. So at this moment, it's $148.79. That's the blue line, okay? So this is the 50, 100, and 200. For this particular strategy, the 50-day moving average is the shortest term moving average. That has the shortest duration. The shorter the time frame, then the more volatility it's going to show, the more noise, the more it's going to show responses to different changes. So with this strategy, anytime the green line is above the gold and the white, then that tells you that it's a bullish trend. It's a bullish direction. Whenever you hear somebody say bullish or refer to the bull, bullish always means it's a very positive thing. That means the stock is going up. Bullish means upward. So when the green line crosses above both of these other two lines, like it did right here, it crossed over both lines around June 23rd. That was a very bullish thing. That tells you the trend is moving positive, that's bullish, and the stock is going to go up. Anytime the green line dips beneath both lines, let's say right here, March 5th, it dipped below both of these lines. It went below the gold one on February 24th. That was your warning. Something's going on. You can check the news. It continued and it went below the white line on March 5th. At that point, the stock was $129. Okay, you can look all the way across here. It was $129 once it crossed beneath that white line. It continued to go down, so that's bearish. Okay, if it dips beneath, that tells you the trend is now turning bearish. Whenever somebody says something is bearish or they refer to a bear, then that generally means, I would say negative, or that the price is going to decline and go downward. You actually want to try not to think of bearish as negative, because a lot of people make money when the stocks go down and decline in price. There's lots of ways you can make money when a stock goes down. So that's just a subject for other videos. So bearish, you may not want to look at it necessarily as being negative, but just know bearish means it's going to decline. And you can tell right here on March the 5th, when it went beneath that white line, it was 129 and it dipped as low as $121. Okay, so the price did drop. Here it starts crossing back up again. What day is this? April 9th. And then here it crosses it up above both. So that tells you the trend is now turning bullish again. Okay. So that's generally how you can recognize a trend change using moving averages. Whenever the short-term moving average, which in this case, the short term is the green one, whenever that moves above the long term, the longest term is the white one. Okay. Whenever it moves above that white one, that is called a golden cross. Golden cross is very positive. That normally means that's very bullish. That's the golden cross. And likewise, when the short-term moving average dips beneath the long-term moving average right here, that's called the death cross. Death cross meaning, okay, it's turning negative. So those are terms you'll hear people reference. They'll say, it happened. We just hit a golden cross on Tesla. And everybody knows what that means. Or, hey, we just hit a death cross on such and such on Microsoft. And that's kind of a, whoa, let me go take a look. So that's some terminology you'll hear traders use, and you can kind of know what that means. Okay. This particular moving average strategy, the 50, 100, 200, this is generally a good one for long-term investing. If you're making long-term decisions for your retirement portfolios, which that's one thing I do trade in my Roth IRA. This is what I use to determine long-term direction, okay? And for short-term direction, I have a different moving average that I'll show you. But before we do that, I want to go to the next level of indicators. All right. So the next thing you'll want to know how to do, and I'm going to zoom out a little bit to make this a little easier. I think that's fine. What you want to be able to do is identify what's called the support and the resistance. The support basically just tells you the floor, generally the lowest range the stock generally will be in. And the resistance is basically your ceiling. So that kind of gives you an idea of the range the stock should trade in. All right. And so that's something else that you can know and keep in mind. I kind of have it memorized for a lot of my favorite stocks. So I already kind of know I can recognize a price change and see this as something important. So looking to identify the support, if you look at this blue line, okay, let me delete this for a second so I don't. We're looking at the blue line here. That's the most jagged. That's the actual stock's price. So you always plot the support and the resistance on that. All right. And so you do that by trying to make a diagonal line across each of the negative points that generally goes all the way across. And it does take practice. So here, this would have been a really good support line, but it did jump up in July. So since it's so much higher, I have to come up a little bit. And I'm going to make this point my last stop. All right. So the resistance line is that dark blue line. Okay. Right around 147, 148 are the support line. Your resistance line, you do the same thing, but you do it for the higher price targets. And again, it's just kind of an average. You don't have to be exact. So you're kind of going across and about right there. So my resistance line is about 158. So your general range for Apple is between 148 and 158. So that kind of gives you an idea. You already know that's about the range it should trade in. And the 158, this is actually kind of conservative. You could actually do a second level resistance. You can have, resistance level 1, resistance level 2. If I do that, level 2 would be using maybe this one. This is actually pretty high, but let me lower it a little bit. So if I use that one, that's just too high. I'm not even comfortable doing that. That's actually a little too. I'm not even. If you look back here at this one, that's so high that I was considering. That's January. I'm not even going to keep that one. I don't think that's recent enough to be relevant, but let's assume it was. I could do that and then say, okay, resistance level 1 is about 158, level 2, 178. You could do that in some cases. I actually don't feel comfortable with that in this one, so I'm gonna delete it. But that's your support and your resistance, and so you can do that to kind of know the range you're looking in. So if the price right now, the stock actually is pretty close to the support line. So if it drops here beneath this support, then that's a warning. Okay, normally when a stock dips beneath the support, that's a bearish sign, and it may fall a lot further because now it's broken out of the range. A lot of times the stock will stay in the range. If it dips beneath the range, that's a very bearish sign, and that tells you it may have a lot more falling to do. And in that situation, you have one or two decisions. You can sell and wait for it to come back, or you can also just buy more shares at a lower price. Normally, I recommend buying more shares at the lower price. And, let's say right here, if you bought a whole bunch of Apple shares at 150 and it dips in price down here to let's say 135. That's a $15 discount. So if you buy a whole lot of shares at 135 and then it raises back to 150 in a month, you got a 15% discount, and your average cost will be lowered from 150 to maybe 145. So it lowers your overall, it's called dollar cost averaging. That really is the best strategy if you're new. It takes a lot of practice to be able to say, it's falling, I'm going to sell, I'm going to buy it back when it goes up again. Most people fail at doing that and identifying how to time that correctly. I'm going to show you how you can time it correctly, but that requires you to check every day. So that if you're not the kind of person to put a couple hours in each day, then you're better off just dollar cost averaging. So I'm going to delete these just to. Okay, the next thing on here, you have the volume. I do like to pay attention to volume, so it's at the bottom of all my charts. Volume just tells you how much buying and selling is going on at any given time. So right here, the volume tells me there's a lot of selling that went on within the last week. All these red columns, that's selling. So that kind of gives you some indications that there's something going on a lot, and that might affect the price going down, which it actually kind of did if you look here. And the green columns show you when a lot of buying was going on. So with the volume, it just gives you a good indicator that you can use along with everything else to give you an idea of just the buying and selling that's going on at any given time. Okay. In this strategy, with this moving average, you can backtest this at any given point. So I'll show you some of that. And anytime the green line goes above both lines and you just map it out, right now it's still above. So I'm going to stop here. So from this point, that was June 23rd. From there to now, it's 18% higher. That's an 18% gain in 85 days. 18% is huge in the stock market. If you were following this strategy. Okay, I can go, let's see. And again, you're looking for it to be above both right here. All right, this was November 2020. It crossed above both and it started to fall right about here. This is where you would have sold. 14% gain over the course of 88 days. Okay. Now, Apple isn't a very volatile stock. It's not going to just go crazy a lot. This is a long-term hold. But again, this moving average formula, you can backtest this on any stock or index, and 9 out of 10 times you're going to find that it works. All right. So I'll do it here. It crossed over right here, last May. From then to about here, it fell beneath the gold line. You would have had to sell. 66% prop gain on that stock over the course of 140 days. All right, let's switch it. I'll do Tesla. And again, this is my long-term. This is my long-term chart. All right, something doesn't look right. I don't know why it looks so crazy. Here we go. It's a little better. I don't know why that looks so odd. All right, this is Tesla. Tesla is a more volatile stock. Volatile meaning it moves. Its price action is more intense, as you can see. It's not something that just moves a little slowly like Apple does. So right here, it crossed over both lines on July the 12th. It's still above now, so we'll stop here. But since July 12th, it's up 16% over the course of 66 days. All right, I can go here. And this is a really, really good one here. This is crazy. Last November, it crossed over both from November to about here. What day is this? February. 92% over the course of 91 days. So in 91 days, 92%, that's almost 100%. You could have almost doubled your money in 3 months on that one. That's pretty crazy. But like I said, you can back test it on almost anything. Whatever stock I put in here, we'll do maybe AMD's a good one. I tend to like tech stocks, so that's my bias. AMD, all right. It crossed over both right here, June 15th. From there, it's actually dipping. You would want to sell this today. Today. Actually, I like AMD, so I actually wouldn't. But if you were following the strategy, you would sell. Sometimes I don't. If it's a really good stock, this is a really good stock. I wouldn't even sell it. But 35%, almost 36% over the course of 97 days. 36%. And just to do the inverse, if you trade it consistently, it saves you on some of the decline. So here, it fell beneath both the green line fell beneath the gold and the white here on February 18th. If you would have sold then and waited it out, you sold here at $89, $90. You sell and wait, you buy back in right here when it crosses, you would have bought back in at $79. So you're buying in more shares now. So that's how you get rich basically. You sold here at 90, you waited for it to drop. Here it starts to climb again at $79, you buy back in, and then that's when you get this 35% gain. So that's pretty much all I do. You buy when as long as let's move over here so it's not as ugly. And I'll move it down. As long as the green is above both lines, you buy. If it falls beneath, you sell. And then when it goes back above, you buy it again. That's all you do. If you do that, buying the actual shares and not doing stock options, I am not talking about options. Options is a lot more complicated. As long as you just do that, you will make money 99% of the time. That's all you have to do. Granted, if you're checking, you do have to check. All right. And you can even do this and look at the entire stock market. All right. SPY I don't think that was the real. Yeah, it's fine. SPY basically is an index that follows the entire stock market. So you can run this the same way on SPY. Why is this looking so crazy? Let's see. That's what it was. Okay. Sometimes you get so zoomed in on these things. So this is the S&P 500 strongest public companies in America. You can run the same strategy there. And the S&P has obviously been in an uptrend for a very long time. I can't even. You can go back probably 10 years at this point. But let's see. You did have it do a little bit of movement. It's generally been high all this whole time. But if I do it from here, that was last November. From there until now, it's still above both lines. That's a 31% gain in the last 304 days. But The S&P has been above for a long time. Okay, so here's a big drop here, a huge drop. This is March. This is March 2020. Oh, and we all know what happened then. Coronavirus killed the stock market. Everybody lost all this money. I was fine. This is why I was okay. Look, the stock. This is the blue line. It drops beneath. Let me go here. It dropped beneath both lines. Or I'm sorry, the green. The green is your shortest moving average. It dropped beneath both lines right here. What day is this? On March the 5th. And it was at $321. At that point, it fell the price actually fell all the way here to 219. Whew, Lord. That's a 31% drop in a matter of 17 days. That's pretty bad. You could have avoided all of that and waited until right here. What day is this? May the 18th. So from March to May, you could have pretty much just sat out and waited, and you would have saved yourself from an 11% decline. And then you could have bought back in right here because it was above the white line and the gold line at $287. So you sold at 321, you bought back in at 287 at a lower price, so you're buying more shares, and then from here you could have written it on all the way up. Okay, so that's pretty much, it's simple, and this works better than anything I've ever seen. So this is what I do, and it's made me a lot of money. And again, this is the long term. Now, like I said, you can tweak this a lot of different ways. This is my short term one. It's the same concept, but it's basically with a short term moving average. All right, let me delete these. This looks kind of messy. All right, this one, same idea. You still have your volume down here that shows you all the buying and the selling. Except instead of having a 50, 100, and 200, this is a 10-20. So the yellow line is 10-day moving average. The red line is the 20-day moving average. Okay. And I like having these additional candles. This is called Heikin-ashi. I think it's a Japanese candle. But it just gives me even more indications of when selling is happening and when buying is happening. So all these little green candles reinforce that we're in an uptrend versus the red candles telling me that we're having some selling, pay attention. But it's the same idea. The blue line is the actual stock price. As long as the yellow is above the red, you buy. When it drops beneath, you sell. That's all you do. Above, you buy. Beneath, you sell. And this is a short term, because these are short term moving averages, this is going to show you a lot more price changes. And this is something you're doing just for purchase, buys, and selling. You're doing every week, every month, around that range. And if you buy and sell based on this, you can make a lot more profit. And then roll that profit into your long terms. But like I said, it still works. We can back test it on anything. So here, June 7th, this is still Apple for right now. From June 7th to, it fell back beneath right here on July 20th. 16% gain over the course of 42 days. And then you can avoid this decline here and then buy back in. All right. Let's switch it and we'll do Google. It's another one of my favorite stocks. Okay. Let's see. All right. So I'm gonna do that a little more. So Google, same thing. One second. I was trying to clean this up a little bit. There we go. All right. Same thing. it crossed above the yellow line, the short-term line crossed above the red line right here on August 24th. From there until right here, it crossed below. I actually would have kept it. I wouldn't have sold, but 5%, 14 days. 5% is a very strong profit. You're actually, it doesn't sound like much, but a lot of times for a short-term trade, 3 to 5% is my goal normally. 5% and 10% is huge for stocks. Now for crypto, it's a whole different ball game. You can have much bigger percentage. Oh, and by the way, another thing I like about TradingView is that I can do this analysis for stocks, for forex, or crypto. I can analyze those charts the same way, all right here. All right. And in crypto, you would want a little bit more, a shorter term indicator like this, because crypto is a lot more volatile. Same thing right here. What day is this? July 22nd. The yellow line crossed above the red, you buy. And here it's basically kind of going sideways, and it dips below more pronounced here on August 19th. So that's almost an 8% gain, 27 days. So like I said, you can back test this on pretty much anything, and 99% of the time this is going to be effective, and it's going to show you, it's going to allow you to make profits. Like I said, it took me an eternity to learn this, and I just feel like this information shouldn't just be so secluded and hidden. Here it's kind of sideways. I don't know if that counts. That's 4%. I would probably say, actually it kind of went sideways for a long time. I probably wouldn't have sold at that point. I probably would have sold around there, and even that was temporary. So that shows you an 11% profit. So that's pretty much your idea. The 10-20 moving day, the 10 day to 20 day moving average is for your short-term trading. Short-term is usually a little bit more aggressive, that's where you do your higher risk stuff, and the long-term trading is what I normally do with the 50, 100, and 200. Like I said, that is standard. Everybody does that. And just to show you, again, you can still do short-term trading on the entire stock market too. A lot of people do short-term trades on SPY. That's the S&P 500. I must have already had a chart on this, so I'm gonna see if I can delete that. Let's see. Here we go. All right. So, and I can zoom in, and I can get really specific here, so you can kind of look and see. But same deal. You can do the same kind of short-term trades right here. Across the yellow line crossed above the red on August 24th. You ride it up. It dips beneath right here. What day is that? Actually, that's not very much profit in this case. That's only 2%. 2% is okay though, but still, you can avoid losing money. I'm gonna delete that. And also, just to show you, you can do, like I said, you can do cryptocurrency the same way here. Actually, I'm rusty. All right, BTC. I'm not seeing the Coinbase. Binance is okay too. If you look over here to the right, this is showing you the different cryptocurrency exchanges. It's gonna compare. Normally I like doing Coinbase. So Bitcoin to the US dollar. There we go. All right. So like I said, crypto is very volatile. So you actually kind of need a more short-term indicator. So for Bitcoin right here, this is September the 2nd, it crossed over. From there to about here, that's about 5%, 5 days. Then you can come back here, same thing, it crosses up. I probably would have bought in about here, but From there to here, that's 5%. Like I said, sometimes you'll have just some massive gains here because it helps you identify a trend. And so once a trend is happening, you never know how strong a trend it's going to be. It could be a major one or a small one. And so even if it's a small 2%, 5%, that's great. But then sometimes you'll catch a really big one, like right here. There's a decline here, but it jumps back in. So assuming you just held through that, or even if you sold and bought back in and continued to ride it up. From there to about here. Okay, that's July until August 13th. That's a 46% gain over the course of 22 days. So massive returns. And like I said, it helps you recognize your trend reversals. Anytime you see it dip beneath your long-term moving average and you see these little sell candles that let you know you can sell, you can also look at the volume indicators here in the very bottom. Very basic, but it works. And this has helped me remain profitable for a long period of time. And what I normally do, I'll take 20% of my account will be on short-term trades like this, and then the other 80% are long-term. And as long as you're buying as long as you're above your long-term indicator and you're selling when it dips below. If you do that consistently, you'll make profit. Like I said, you can set up your own charts in any brokerage, or you can sign up under TradingView if you want to save all your settings like I like to. But that's essentially it. As always, you can tweak it. I like 10 to 20 day, and I like my 50, 100, 200. Some people do all kinds of different time durations, and there's other modifications you can look at. Like I have a 4-hour chart window. You can do 1 hour, 30 minutes. There's so much more you can do to continue to find your own personal niche. But I definitely wanted to share it. Like I said, this is the most valuable strategy I've found. There's a lot of other things people do, looking at the slow stochastic and the MACD and all these other little things. And it works okay in certain types of scenarios and strategies, depending on what you're doing. But for me, moving averages has been very consistent and has allowed me to be very profitable. So let me know if you have any questions in the comments. I know it might be confusing, or the terminology may be really different for somebody who's new to the market, but I promise you, if you study moving averages and start doing this, you will start making money. And if you have questions and you need to read further, first off, you can just Google stock moving averages. Google the 50-day moving average, 100-day moving average, 200-day moving average. Google the simple moving average versus the exponential moving average. One of my favorite resources to go to learn pretty much everything is investopedia.com. They explain it in pretty generic layman's terms. Most people use complicated language for no reason, and it's really annoying. So you can look at those different places to learn a bit more. Until next time, continue to strive to learn and to grow, and peace.